In this video, we're going to continue where we left off and complete the cash flow statement from operations, the cash flow provided by operating activities. So in the previous video, we followed the steps in the handout, and we started with net income. We got that from the income statement. Then we went to depreciation expense. We put that in as a positive. Losses, we always put those as a positive. It says add any losses. And then gains, we put that in as a negative. We subtracted any gains. All right. And now we come to the section of the cash flow statement that is very challenging for most people. It says review changes in current assets, minus any increases in current assets except cash, add any decreases in current assets except cash. What does that mean? Well, if you look at the handout here, it looks at here's a list of the current assets. This is used for operating activities. What it's saying is you're going to look at the current year balance for current assets compared to the prior year balance for current assets. If there's a decrease, if the current year compared to the prior year, if it's a decrease, you're going to add that decrease. If it's an increase, you're going to subtract that increase. And that is the opposite of what you would think. You would think if you have a decrease, you subtract, and if you have an increase, in you add, but that's not the case for cash flow statement. Remember, what we're trying to do is we're trying to make an adjustment to the income statement to only reflect cash. And I'm going to explain this later when we actually get to the accounting cycle. But for now, you just need to trust me with this rule, right? If current assets increases, we subtract. If current assets decreases, we add. So let's go to the balance sheet. So here's the balance sheet, and you'll see we have the current assets, now everything except cash. So we leave cash out of it, and we have accounts receivable, inventory, office supplies, prepaid insurance, and rent. So let's look at the balances. So this is December 31st, 2020. This is accounts receivable, has a $20,000 balance. In 2020, it had a $31,000 balance. In 2019. So if you look at this, there was a decrease of 11,000. How did I get that? 31,000 minus 20,000 is 11,000. So there was a decrease of 11,000. So what does my rule say? It says if there's a decrease, we add. So I'm going to go to cash flow, right? It was a decrease in accounts receivable of 11,000, so I add 11,000, and that's it. That's all you have to do. Well, let's look at the other one. Inventory. So inventory was 25,000 in 2020. It was 15,000 in 2019. So we went from 15,000 to 25,000. That was an increase of 10,000. I take the difference between these two. What does my rule say? When we have an increase, we subtract. So I go to my cash flow statement, and I'm going to minus 10,000. All right, let's look at supplies. So I look at office supplies, it was 30,000 in 2020. It was 27,000 in 2019. So that's an increase of 3,000 from 27 to 30. So that was an increase of 3,000. What do? It says, my rule says, if there's an increase, we subtract. And so here I subtract 3,000. And so let's look at prepaid insurance. Prepaid insurance was 40,000 in 2020, 67,000 in 2019. So that was a decrease of 27,000. What do we do if there's a decrease? If it's a decrease, we add. So we're going to put that decrease in as positive, right? Very simple. And then the last current asset, because we're only doing the current assets except cash, we had 60,000 in 2020, 72,000 in 2019. So it went from 72 to 60. So it went down by 12, right? How did I get that? 72 minus 60. 72 minus 60 is 12,000. And so I come in here and I put in 12,000. Why did I put it in as a positive? Because whenever you have a decrease, you add. All right? So it's very simple. You look at the current assets on the balance sheet. If it's a decrease from prior year to the current year, you add. If it's an increase, you subtract. Now, here's where it gets tricky, because now you have to go over to current liabilities. And when you go to current liabilities, the rule is not the same. For current liabilities, if there's an increase in current liabilities, you add. And if there's a decrease in current liabilities, you subtract. So this is the thing you have to remember for cash flow from operations. You have to remember the rule for current assets and the rule for current liabilities. And if you remember that, you will be okay. So let's do what we did for current assets for current liabilities now. So here's accounts payable. Okay, so I'm going to go to accounts payable. And here we have, these are the current liabilities. So we're going to do all of the current liabilities. So in 2019, we had 130,000. And in 2020, we have 100,000. So we decreased accounts payable by 30, right? So if we decrease by 30, what do? We subtract 30,000. Okay? Why? Because the rule says if it's decrease, you subtract. Okay? Let's look at interest payable. So interest payable, we had 30,000 in 2019 and 25,000 in 2020. So we went down again by 5,000. So what do? According to the rule, if it's a current liability, if it's a decrease, we subtract. So I'm going to go over here and I will subtract. Let's look at utilities payable. Utilities payable, we have 32,000 in 2020 and 19,000 in 2019. So we increased, right, by about 13,000. So what do? If we have an increase in current liabilities, what do? I add. So I'm going to add 13,000. Let's look at salaries payable. Salaries payable, I had 12,000 and then I went to 21,000. So that was an increase. What do I do with an increase in salaries payable or an increase in a liability? If it's an increase, I add. So I went from 12 to 21. So that's about 9,000. So I'm going to put in 9. And then the last item is unearned revenue, which is 22,000 and 29,000. Was 29,000 in 2019. It went to 22,000. So that's a decrease of 7,000. So I'm going to go in here. What do we do with a decrease? If it's a decrease in current liabilities, we subtract. Okay, and then there's no more current liabilities. So what you have to do is go to the balance sheet. You're going to do that exercise for all the current assets except cash, for all the current liabilities, not the long term, just the current ones. And you're going to follow the rule. If there's an increase in a current liability asset, you subtract. If there's a decrease, you add. If there's an increase in a current liability, you add. If there's a decrease, you subtract. And you follow that rule. When you finish all of these things, then you add. One of the big mistakes people make is they forget to include net income. So you have to take net income. You're going to add the 40,000 plus all of these numbers. You're going to add all of these numbers together. And then you will get your net cash from operating activities. So you have net cash provided by operating. If this is positive, this is net cash provided by operating activities. If this is negative, this is net cash used by operating activities. So what does this tell you? This company had net income of $40,000, right? That's profit. Well, how much of this net income is actually cash? Well, this $40,000 actually translates to $60,000 in cash. So this company was able to generate $60,000 in cash from selling goods and providing services. So this is good. If net cash flow from operating activities is positive, that is a very good sign. Okay, so that is how you calculate net cash from operating activities.